Okay, everyone, what's happening? We got a fun day today. We're doing cash flow waterfalls and visualizations. Both are exciting. I don't know which one to do first. I guess I'll probably do the waterfall, joint venture waterfall option, and then into the visuals. Before I get started, remember to check out more at smarthelping.com. The template I'm working on now will be in the startups and industry specific financial model bundle. We'll put it in here. Also, you can check out all the models I've ever built. You can buy everything on the site for $9.99. So check it out. Tons of value here. Let's sound check and get our link out to Twitter. Sounds good. And we're doing modeling. We're doing visuals today and JV waterfall integration. All right, so I'm really happy with how the template currently works. It's really just focused on the drilling and extraction of oil or gas and what it costs to do that and what you're going to make over time based on all these different assumptions in the deployment schedule. We added fixed costs yesterday. We got all the way down to cash flow and internal rate of return. We added a couple metrics here. I'm going to do a metric, a cool visual. I'm hoping it works out where we can see the units extracted over time, and we'll be able to see each cohort's depletion curve happening. So it really visualizes the value. Probably also, do we have revenue? Yeah, value of units produced, so we can see this effect over time as well as like essentially what's the initial value flow rate, and then what's the value over 20 years or however long you define the production period to be for. And actually, I'm going to extend this out to um, 15 years, I believe. Is it 12 times 15? Yeah, 180. Let me see. Does that get us? Well, 20 months. Let's just go the full 220 months, just so we can see a full. Okay. Now, why did this go so negative? Oh, so this is very interesting, and this is one reason why I built this template. You can see the value of production over time. If, right now our monthly decline is 3%, you can see we're seeing big negative cash flows because with that decline in production and flow rate of the wells, the value of what you're extracting is less than the cost to extract it. So you're losing money now based on that. So that's an important dynamic. Actually, that's one of the points of this whole template. Let's say this was 1.5. Now what? Yeah, now it's insanely profitable again. So that flow rate decline curve is super important to the value of these cash flows over time. Okay. So what did I say? We're going to do the waterfall first. I don't think there's anything else we need to get in here. I think we have all the items we need. So I have a template for this already, the monthly waterfall. It's in the joint venture bundle. Oh wait, no. Yeah. No, it's in the real estate one for self-storage, I believe, has got the monthly. So this template has cash flow waterfalls here. Now this goes for how long? 179 months. And we'll have a discounted cash flow analysis in here too. So copy this over. These types of businesses very often have joint venture waterfalls. You see they're kind of like real estate where you've got steady cash flows over time. And those are where you see the waterfall templates used for joint ventures. Now we're also going to show an alternative that's not a joint venture, potentially. Now we need to drag this over further. Okay. So how many? August 38. Let me see the end month here. December 42. So the first part of the model is done where we can see like all the operations, cash flow, everything. Now we're going to look at what happens if the operation is a joint venture. And let me just put this here. Okay, so we need to go 3 more years. All right. Now, with a waterfall, we're trying to look at the internal rate of return. We need to convert the annual hurdle rate. This is the annual IRR hurdle to a monthly. So that's what this template does. And you can see the math here to do that. So it's converting this hurdle rate to here. Here's the check, 10%. You can see this IRR 10%, which we have to use XIRR to figure that out. Change this to month. Oh, okay, this should just be the same as this, just a 1. Okay. Here, this is a manual input now. So you can define between the LP and GP who's contributing what of any contributions, which we have to code in here. Let me make sure this is period 0. Just looking at this. These will be also hard coded on. Okay, so contributions, we simply say if the monthly detail cash flow is less than 0, then give me this value. And same for this, but the opposite. If this is greater than 0, format this here. Okay, so there's our initial costs. Now we drag this all the way over. And you can see we start to make profit in month 6 or started some distributions. This initial cost is let's say it's 90-20 or 90-10. So what that says is LPs 90% of the cost, GP's 20%, and the LPs are getting 80% of, and now in this case, they would at least be getting 90. Sometimes the first hurdle rate's 100%, which is a hard preferred equity. Or as they say, the European style, where the LP gets all of their cash back, or until they reach their hurdle rate, they get all of the cash. Um, well, I say European style, but really these things can be structured however you want to structure them as long as both parties agree. This is a common one where you, up to this 10% internal rate of return, here our LP in this case will get all the cash. So the split is 90-10 for investment, and then LP is getting 100% of these cash flows. Now in month 11, we now have gotten paid all the money back. So 38 million. Here we've invested 42. So this is 38 plus, yeah, this 5.7. You're at 44. You invested 42. So now you've reached your hurdle rate already. And now we go into tier 2 and tier 3 and tier 4, and these split according to these here, based on the IRR of the LP. So this hurdle always applies to the LP, and the whole point is you're incentivizing the operator to do a good job for the investors. The better job they do, the more promote they get. So the GP starts at 0, then they get 25% of the cash flow, then 30, then 50. And they're getting more as they return higher returns for the LP. So that's the whole point of how these things, the point of them. So there, once we get the LP paid back, you're now all the way to over 20% internal rate of return for the rest of the way. Now, if there is another month where there's a negative cash flow, you would restart with new investments, but there is not here in this case. So after the first initial deployments, you have enough cash flow to cover any future deployments and also distribute. Here's the final internal rate of return. Now, if we were to say, let's say this is 95.5, you give the GP a little bit until you get through to that first hurdle, then it changes. So, and that's basically it. That's the hurdle, or the joint venture. This is the most general structure. Now, there's a lot of different ways you can do these, and you'll see on my site here under joint venture templates, there's a lot of different ways to structure joint ventures. This is the one, this structure is what I'm doing right now, but you can do this one. The mixed use one uses this. This is same, but it's a little bit structured differently in the math, but it works the same way. It's just a little bit different way to get there. Then preferred equity type 2, these are a little bit different. This allows a subordinate waterfall that has a hard preferred equity on top of it. This is using equity multiple as the hurdle rate instead of internal rate of returns. That's a fund. Preferred return, which is completely different than everything else I've talked about. So there's a lot of different ways to go about this. All right. And by the way, this kind of modeling is very, very valuable. So if you get really good at this, it's a very, very good skill to have. Now we need to update our formulas in column D to go all the way to column IJ. So we can't forget to do that, so that we're capturing all of the cash flows that's happening. Now really, I could do a find and replace, but I'm worried sometimes when you do that, you might catch other letters that you don't want to be changed. Now, honestly, let's see, do we have anything else that has GB in it besides just that endpoint? I don't think so. So in theory, we should be able to sum this up because there's a variance here because we haven't summed up all the cash flows. If I do everything that says GB, I want to replace with IJ just in this sheet and just in this column highlighted. Okay, there we go. And that's accurate. Now we balance. Just want to make sure it looks good. Check these. Yeah. Okay. Looks like they all updated properly. And these are just some checks on what the waterfall is producing for each tier. Oops. Okay, this all looks great. All right, now the discounted cash flow analysis is just taking the value of the GP and LP's cash flows, then discounting them. Period zero, it's just the same because it's period zero, so it doesn't matter, but we'll put it at 0.8. And you see we're discounting it at the monthly compounded rate of this annual discount rate here to get the monthly, the present value at each month in the future. So you can see already in month 10, 1.7 million is actually worth 1.6, and here it's 10.3 is worth 9.5 at this discount rate. Now, if you plug in the internal rate of return, so if we take the LP's internal rate of return and plug it into the discount rate, it should get something very close to zero. Now there is some rounding. Yeah, so you're at 52,000. But it's close to zero, and you're looking at you know, what is this? 2.54 billion, and you've got a 52,000 net present value. And the reason why that's a little bit off is you're doing a annual rate into a monthly. So you see a little bit of a variance there. And we're using the XIRR function to calculate the overall internal rate of return. And the whole point of having this is you can plug in any discount rate to figure out what is your actual net present value. So these internal rate of returns are 284%, 1,210% for sponsors. So at a 10% rate, that's way lower than the IRR, so you're getting a very high net present value. Now, in theory, project management theory is positive NPV should mean you should go on it. Now, what your discount rate is that you apply is going to depend on a bunch of different factors. The risk of the endeavor, risk-free rates. Now, with oil and gas, it's assuming you're going to find oil. That's the whole. Once you know there's oil there, this rate would go down a lot. But before, the rate could go up because you don't know if you're going to find oil or not. So the potential future cash flows are fairly risky. Now, if you have a different style joint venture, we're going to put JV option 2 here, where you simply define GP contribution Well, actually, there's no point. There's no point to reiterate this. You can assume, let's say the split is 90-10 and the return is just no matter what hurdle you're on, let's say the LP is going to get 80% and the GP gets 20. You could just plug in 80-20 the whole way. And then essentially it just still goes through the hurdles, but it doesn't matter what hurdle you're at, you're just splitting all the cash 80-20. And that's what I was going to show you is an option where there's no waterfall variant like changes, and it's just a flat rate that's shared the whole time, but you can just plug that in here and it would be the same thing. So here, no matter what hurdle you're at, you're splitting it at 80-20 in this case. And the contributions could be whatever you define here. So that is, there's no need to to build something that this can already do just by adjusting the percentages. Okay, so that's fine. I think that's it for this. Let's put in, and trust me, this logic here is not super if you've never done a waterfall, this stuff is really valuable here on how this works, and it's not easy to do if you've never done it. Okay, so visuals. This is the fun part. This is what I'm actually excited. This will be satisfying to build. All right. So, oh, actually, before we do visuals, we need to do an annual waterfall summary because it's kind of hard to see on a monthly level what's actually happening. Because you have to scroll all the way over, and it's hard to aggregate that data in your head. It's good to see like when cash flows happen and all that, but you want to see an annual summary too. So to do that, we're going to have to sum up GP distributions, LP distributions. We have to make a summary here so we could put these, sum up the whole thing. So GP are all of that, and this will be the LP. Okay. And then we'll sum this up on an annual summary. We'll get the years up here. And if there is no joint venture, that's fine too. You could say the LP is 0 and the LP, there's no LPs, it's just the operator. And that's fine. Then all the cash flow will go to the GP side of things. Okay. Oh, so we got the years. So we want to put, and I've got this summary actually already done in, look at the hotel. I think the hotel template, I built a summary. See here. Here it is. So just something like this. Oh, hold on. What cells were that? B3. Okay. All right. So let's do our sum ifs. So for contributions on sponsor GP, it would be row 80 if row 1 equals this. And we can lock these and then use this going forward as well. So there's the GP's contributions. Distributions, there's no, we're not doing any fees or management fees right now for this, so we can delete this. Okay, and then distributions is that what we just did down here for, so 87 for them. Now the check is taking the total cash flows minus the total for the GP here. Now, hold on, did we miss something? So these totals 1.4, 1.4, and I've got 2.2 billion. Oh wait, no, 2.6 for the sponsor. Let's see, 79, is that the one I'm doing? Yep. So let's look at the formula, because it definitely should be matching up. Oh, duh. Undo. Or remove, this has got to be 20 years, not 10. So we got actually a full 20 years that we got to account for. Let's make this a little bit smaller so we could see it. Also, we need to change the format. All right. Let's make the font a little bit smaller as well. It's still too small. We gotta make this a little bit wider. I'll go 10.5. Okay. So you have contributions, distributions. Now this total should equal this total, which it does. So there's that check. Now we do the same calcs for the LP, except now we're doing, so their contributions are in 73, row 73. And then their distributions are in 88. And we can see their cash flow over time, and then this should equal that. So there's our checks. Now this needs to be updated. I'm sure it's referencing. I like the colors on this. Yeah. Okay. So just remove everything. Sponsor cash flow. Now you see the curve. That's completely happening because of this production decline curve, and then against how many holes are being drilled. Now, if we were to continue drilling, or let's say we were going to stop this at month 118. Well, I don't know what that'd be, 10 years roughly, almost. So 2023, if we stopped it at December 2032 and did a 10-year, you can see now you're slowing, but you haven't actually started to go down because all the wells you're still producing and the new production is higher than the costs of for the wells that have been already drilled for a while. So that is interesting to see. Okay. Oh, let me change the colors of these back. I like those other colors a lot. What was that, like this? And then this was like darker. Okay. And we could widen this out a little. All right. Now, if we stop drilling at month 84, you can see you should be getting pretty good production the whole time. So this is going up, and then we're flat. 140, 146, 50. Because remember, the prices also are going up by an annual rate, but our production is going down, I think 7 years. So that's why this seventh year is where you see the cutoff, because 84 months is when we're stopping with the initial wells that we were drilling. And then we're still adding, but they're only going for for 84 months after that. Now watch what happens when we do a full 20 years. You're going to see that fall off, and then we're only deploy. So month 118 is the last time we actually drill. We've got fixed costs going. So let's look at the annual detail. So this is still profitable, but then you start to fall off at the end. So if we look at the cash flow here in the last few months, it's still positive all the way up until year 18. These are years, not months. So maybe we'd stop it, in this case, at the end of 2039, run the analysis through. And then there's the waterfall and the curve of cash flows. So this is a really cool model. Anybody looking to drill in oil and gas and wanting to look at internal rates of return, joint ventures, cash flows, and be able to just easily adjust all of these assumptions is going to be finding a lot of value out of this model. All right, so now we go into visualizations. Now that we have all the cash flow, let's just have this go for the full 20 years, and I'm gonna have deployments happening all the way through to 136. We'll say, now, what would be interesting, I don't think there's a way, but if we could see what the value of, what's the monthly value of this production versus the monthly cost. I think that'd be interesting to see at the end month, whatever end month you are, so you can kind of see, well, is this still profitable or not? Wonder if we could do that. We'd have to take, this is a production per day at the stop month. Let's see, you would take this times days in the year, 105,000 units, raised to the year times the price, but you got to raise it to the growth factor based on the year you're stopping. Which would be, we might be able to do this actually. Let's think, because that'd be pretty useful to see. Or do we just take value of units produced? Because this is going to change over time. But really, we just want the month. We would want to know what's the monthly value on the exit month. So can we just pull this? I believe yes, actually, should be a pretty simple calculation. So let's look here. Summary data, let's extend this out one more month. And we could say this is actually monthly value of units produced end month. And you can compare that to what your expected costs are to do the extraction. And I believe I just simply take index, take the value in here. If the age of, oh, do we have the production age? Oh wait, we should. Yes. So we measure it against this month number here. And what we measure, we got to look up this value against this month. And there you have it. So, and on the end month, this is what the value of the units being produced is equal to based on all these other assumptions. So you're still, I mean, your ongoing costs for the cohort. Oh, wait. The ongoing cost is per well, right? So this is all per well. So if we go to the cost, figure how we figure out this ongoing cost, we're multiplying D6, J6, and F. Oh wait, no, it's either D6. No, it's J6 times F, J times F, J times F. So that would be, yeah, the well count times the ongoing exploration. So you would have to multiply this cost per well. This is all per well. So at 50,000, if my ongoing cost is for successful drilling, extraction is 50,000 times 10, so it's 500,000, and I'm still making 773, so it's still profitable. And we could actually show that right here. And gross monthly revenue per well at end month. So this calculation, we do the total value of units produced times the amount kept after any royalties. So that's that value. And then we need to subtract the ongoing extraction costs times the well count. And that should give us a nice high level view of, how much essentially what kind of margins are we making on the end month. So still 400,000. Let's format this actually a little bit differently. And I believe this is really important to have right here, so I'm really taking my time on it to make it good. And you have that for all of these. Let's see the match here. Yep, that goes down. E5. Okay, yeah. So that's all good. Now let's see if it actually ever goes negative. I'm kind of curious. So let's say we go for 10 years on these. Barely on the first one. So at the end month, you're 17% of your max flow rate. And then based on the average price change of the units you're selling and this 1.5% decline, you are barely, so the value is 492, but the actual gross monthly profit is 168. And this 168 is the same number we did here on the monthly. I believe this number, net revenue, which is taking the total gross less the ongoing extraction costs. Yeah, so it's the same number. That's basically taking this number that's doing it on average, and we're putting it onto each cohort individually to see. All right, so that's cool. That's a good framework to have, or approach to figuring out when the end month should be. And it's, again, the decline rate, starting flow rate, price change, you know, the royalties, that's all going to have a huge impact on what number makes sense for here. Now, if we go a little bit longer, 150 months, you're still positive. Now here it's 0 because, now why is this 0? Total units. Since this is a unit count, this is a dollar count, I do want to put dollar values on this actually. But I'm trying to figure out, why is this monthly value of units produced at month one? Oh, there is no month 150. Month 150 would be off the chart for this. So, like, let's think. That's fine. That's fine. So if U5 equals 0, then 0. And that, yeah, I mean, because if you're starting a well, if you're starting a well in month 85 and it doesn't stop for 150 months, that's what, 150 to 235, and we're only going for 240 months. So those should be, oh wait, 85, but the actual production starts in month 85, 6, 7, 8, 89. So 89 plus 150, 239. Wait, why? So this should have a value. Oh wait, that one does. At 88, you don't anymore. Right, because 88, 89, 90, 91, you're starting in month 92 production, and 92 plus 150 is 242, and we don't have month 242. We stop at 240. So that's why there's no value here, and that's okay. It's just a limitation of the model unless you drug it over more. You could take this monthly detail in the matrix tabs and just, go further than 240 months if you wanted to. All right, so even at 150 months, these are all still profitable, not super profitable, and they may not be covering the fixed costs at that point. Well, so if we look over here, they very much are still. So your cash flow is still positive. It's just a matter of the value of that. And when you can run this analysis on just a single cohort of wells, like just right here, just for the first row, and clear everything else out and see all this data. And you could do it if you wanted to show, up to, what do we have here, 46 cohorts of drillings, and each cohort can have all this data defined separately for it, and you can aggregate that data across all of these calculations here. All right, so this model is awesome. Very cool. Visualizations. So let's do some high level first. Let's do, and I love doing visualizations. Let me pull up something real fast here. We're going to do like revenue, cash flow. One second. Just looking at my, oh, we got 5 viewers. What's going on, guys? We are jumping into visuals. Let me check if I have any messages from anybody. Okay, so visuals. Series name. We definitely want annual revenue. Let's see, where do we have, there's so much good data here. All right, let's just do the top line revenue first. Unit sales. Is this number? Okay. The year. So that's kind of nice looking. We'll take this. Now we got to format how we're going to do this. I always like the light gray. So this is value of units sold per year. And we have right next to that royalties. So for, well, no, let's just do gross revenue. Which is just gross revenue per year, which is just taking out royalties. So you can see here we're at 500 million. After royalties, the top highest level is 478 million. We also have, what else do we want to put in here? I'm excited about some of the advanced metrics and cohort metrics we can put in here. I'm going to use the matrix tabs to show some pretty cool stuff. But we do need high level first. So we have revenue. We could do cash flow for sure. I also want to do a lot of this drilling activity. So let's do on this one cash flow. What else do we want to put in here? Value, revenue, cash flow. Average revenue, net revenue per well. Definitely average success rate. Yep, all of these things. Average net revenue per well. Now for, yeah, I think that's the most important one. And this is just simply following that exponential decline curve, but you also got fixed costs happening that affect that as well. All right, and then we definitely want your drilling success rate in here. So out of all the wells you drill, how many are successful? And this one we could do a data label on. Okay. 21. Okay, perfect. So revenue, cash flow, net revenue. What else do we want in here? We could put in exploration and extraction costs per year. I wish Excel had the nice formatting where it automatically lines up things for you. All right, so drill costs. Now for this, what do we want here? So if we take the total, you kind of want to group them into how much are you spending on initial deployment, like these two, and then ongoing exploration costs are kind of different. So I think for that, the best way is to separate it out. So here we should go total initial deployment costs, total ongoing extraction costs. Yeah, I think those should be separated. So here, initial deployment is this and this. Extraction is, I believe, just the, yeah, extraction, exploration. Okay. Yeah, those are definitely good to have to see per year. So let's get that. Now, as far as the style, I believe we can do both on the same one. So let's get this. And I mean, it's really nice that this model allows you to do the cohort scaling and then just shows you the aggregate effect. What happened? Let's make sure this is correct. Okay, that looks fine. And this one. No, this is not fine. 237. Sometimes Excel gets a little weird. Okay, I want this for these costs here. Okay, and then remove data labels. Move this to the bottom. And then annual. We might want to separate these. Annual. Whoop. initial deployment costs versus ongoing extraction costs. And honestly, we have, so on these costs up here, you've got ongoing exploration, which is kind of part of the initial exploration as well. Like these three here are initially like, here's what you have to spend, and then once you have found a successful well, now this is what you're spending. So we might want to actually map, so we can see, okay, here's what I have to spend, and then here's what I'm spending on these successful wells. So let's actually add up all these three into one, and then this one, let's just do 24 only. Yeah, that's better. Let's give this a legend. So you've got total initial deployment and then ongoing. All right, that's cool. Now we're about to get to the coolest charts ever. Let me just make sure I got all the high level stuff I wanted to. So that. Shoot. Okay, nope. We got to do the well counts and those metrics first, and then we're gonna get to the really cool stuff. Okay. Okay. So for well counts, we want to know all of this stuff. Let's see. What could be? So for this, we'll do this chart data range up at the top, and I just want all of this data, and then I'll select what I actually want to display. So we have this. I don't need data labels. Okay, so what do we actually want to show on the same chart? We don't need the blank series. We don't need drilling activity. So successful drills, explorations drilled per year. Okay, here's what I definitely want on the same chart is active explorations versus active producing wells. So this is interesting. Let's put this on a chart. Got our legend in here. Active drill explorations versus active producing wells. So the blue is ongoing explorations that are happening at year end. Uh, Year end. So this is at the end of each year. How many active producing wells do you have? Well, here we're about 64. And then this is showing you how many wells are you currently working on exploring at the end of each year. Now the other data piece we want, by the way, I like the colors here, is successful drills. We definitely want to know that. Successful drills versus total explorations done. So this will show you the rate between how many were drilled, how many were successful. Explorations drilled per year, so this is a running total. No, we want to see successful drills and total drills done, total explored. And let's change the color because that's hard to see. Okay, so active And then this is, whoops. So this we're going to call successful drills versus total explorations per year. So in year 2023, we had 50 drills and we had 10 successes roughly. Next year we did 30, we had 5.5. And then it was the same 46, 46, 46. And again, this is just based on this data here. So after you put in this here, you'll go to your visuals and just kind of sanity check and make sure you're getting what makes sense. Okay, and then finally we want to know the total explorations that have been done. So that one we just pick this here. And we don't need a legend because it's just one data point. So total explorations done. So this is 440 drill holes in total to produce this. Okay, now we get into the cool stuff. All right, so let's do this. Let me paste this in here and select data, remove this. Now let's see how this comes out. So I want to see number one, we're going to see the units produced over time by cohort. Let me find this. Where is it? One time, ongoing. So total units extracted. And we'll see if Excel breaks on this, but it's going to look so cool. Okay, so it shows us units extracted over time. Oh, shoot. What happened? Oh my goodness. All right, we don't want, it's got 230 data points, or 230, shoot. Can we just not see data labels? Let me uncheck this. We might not be able to put this in here if it's too much. Shoot. So this is called, this is units produced per month by cohort. Yeah, it is not handling this well. Not good. I wonder if we can just do, so that's all of that data. I wonder if we can just do the curves. That might be a little bit easier. I mean, 240, I guess it's the same data though. Same amount of data. But this formula is easier that's happening in here versus what's happening here. Let's see, this goes out for 240. Oh, wait, whoa. 240. What's the curve look like? Yeah, 240. So it's the same. It'd be the same amount of data. Let me see what happens. I don't, if it slows the whole sheet down, we're just going to maybe look at like the first 5. Let me see. Okay, so two. Okay, so that seems fine. It's not really slowing the sheet down, which is good. The second thing is it relevant? Does it even help at all? I don't think so. You can't really see anything, and it's really hard. So what we're gonna do, let's delete this. What we'll do is take the top 5. So the top 5 cohorts, you'll be able to see. Move all of this. We go to this matrix here. We take the top 5 units extracted. So 1, 2, 3, 4, 5. So it's quite a bit smaller. But you'll be able to see the data. 1, 2, 3. Okay, that's 5. Okay, still a lot of data there, but this is a bit easier. And we could put in a legend. So there's your 5. Wait, units extracted we don't need. Okay. And then your period, this is units monthly, units produced by well cohort. And it'll just show you that over time for those. Now, do we want to change this to a line? Probably. And then let's put this back to how it was. So let's just make them all the same for right now. Okay. I don't think we need the little bubbles, so let's just do this. Okay, that could be useful. Monthly units produced by well cohort. And we're going for 150 months, so that shows you all 150 months for each of the 5. This is only, and we'll put it, this is only top 5 or first 5 cohorts only. Now we can do the same thing. I'll put this right below here. We can also do this for the value. So if I go to my matrix here and we have value of units produced, top 5, 2, 3, 4, 5. And show that. Value of monthly units produced by well. Okay, perfect. Now you can see how this will change. Let's say we drill for only, we'll say we do it for the full 240 months. Actually curious how this turns out over here. Let's say 220, so we have some buffer. It's only going to show the first couple because after you get to 16 months, there's no longer, or after 20 months, month 20, there won't be any. Okay, and these do go negative on end months, so that at that point the well is losing money, not making money. Let's try 200 on these. Still losing. Try 180. Still at a loss. Let's try 170. Still at a loss, just barely. Let's try 165. 160. 150 might have been the sweet spot. There we go. That's pretty much, I mean, 155 is a more comfortable number. Okay. Now, one thing we did not do is these starting ongoing monthly extraction costs, we are not raising these costs over time. The fixed cost you can raise over time. The revenue, the price per unit can go up over time. But this fixed monthly cost is the same for the given cohort for the whole life of that cohort. whatever it might be. And then you could do, I mean, you could change the amount for each cohort, but that will be the same for the cohort for the whole time. Okay, so these are positive at the end. So that didn't really change the visual much because we only went like 5 months further. But there it is. So the value of a given well per month starts at 2 million, and then, hey, 5 years later, it's at about 1.2, and then, what are we at done here? 370,000 by like year 12 or 13. Now, if we were to do, let's say the decline rate was higher, let's say it was 2%. Now you can see we're losing money at the end here, and if you look at the visual, you see that curve is a little bit steeper. Okay, so this is fine. I'm really happy with all the visuals. This is high level. We've got our annual waterfall visuals for the sponsors, investors, their return data, IRR. Okay. Let's give this a label so we could put these, say this is contribution and distribution summary GP versus LP. Okay. Now here we see, let's see when we get to 50/50, if we go to the annual waterfall. Let's actually put this at 70, 60, 50. So now we know anything over 20% IR means or anything that's 50/50 means the LPs have gotten over 20% internal rate of return. So that's actually hitting pretty early on in year 2. Now again, I put in arbitrary assumptions. These costs for deployment, you'll go in and put in your own exploration costs, deployment costs of extraction equipment, the ongoing costs, ongoing exploration costs. These will all be specific to your situation, and this will then be very dependent on what's your production for the given wells that are drilled there on average. This is per well. Because remember, this unit count here is per well drilled in this cohort. And you can see here, what was I looking at? Oh yeah, production. So if you look at units produced, you're looking at the curve, which is a percentage, times deployment 5, P5, H5, times the months, days in a month. And you can see P is that, H is the successful drills. Drills. So if we did 10 here, there's only 1.5 that are actually being in production. So you multiply that by that to get the right number. Okay, and this is too long. Let's wind this back to 100 months here. Okay, so they're still profitable. That's my numbers. That's shorter. Okay. All right, very cool. I am pumped. I don't really know if there's anything left. The global control tab has some nice references here if you want to read some papers about oil and gas extraction. This is where I got a lot of the information of how I built the assumptions. Here on the main assumptions, we're just really applying the launch year and the end month. This is where you'll spend most of the time on the deployment schedule. Uh, yeah, fixed monthly costs. Okay, this is awesome. This is really awesome. I'm gonna get the overview video done and get this template out by the end of the week. It will be able to be purchased, and this is really cool. We took a total of 6 weeks to, or not six, 6 streams to build this, which took 3 weeks. And I'll be looking at whatever I do next. Let me know if you have suggestions on the next financial model. Actually, I'll be gone for a bit, so a couple weeks, but after that, we'll start on a new template. Remember to check out more at smarthelping.com. You could buy all the models for $9.99 or check out different uh, bundles or buy individually. I'll see you guys on the next